There's a thief in the night waiting for Americans to turn 65. It doesn't break in, it doesn't ask permission, and most people don't even know it exists until a letter from Social Security shows up saying their Medicare premiums are going up. That thief is called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. In plain English, it's a surcharge added on top of your Medicare Part B and Part D premiums. It's not a penalty, and it's not optional. If you trigger it, Medicare simply takes more money every month, often straight out of your Social Security check. Here's how it happens. When you enroll in Medicare at 65, the IRS already has your tax return. Social Security and Medicare look at your income from 2 years ago, not last year and not this year. If that income is above certain levels, Medicare adds the surcharge automatically. That delay is why people feel blindsided. They may be retired now, but Medicare is still charging them based on a higher income past. That leads to the most confusing question of all. What does Medicare mean by income? For IRMAA, income is defined as Modified Adjusted Gross Income, or MAGI. Think of it as your tax return income, not just a paycheck. MAGI includes your adjusted gross income plus certain tax-exempt income. That means Social Security benefits, wages, interest, dividends, capital gains, pensions, and rental income all count. And this is where retirees are often shocked. Distributions from traditional retirement accounts count too, including withdrawals from traditional 401ks, traditional IRAs, SEP IRAs, and 403b plans. So even if you feel retired, Medicare may see plenty of income. IRMAA isn't about how much money you have, it's about when income shows up on your tax return. Know that, and the thief loses its surprise.
Don't underestimate the impact of IRMAA on retirement assets. IRMAA quietly raises Medicare costs, and it is not just a wealthy person's issue. There are 6 income brackets, and wherever you land determines what you pay every month for Medicare. Once you cross into an IRMAA bracket, you also lose protection under the Hold Harmless Agreement. Normally, that protection limits Medicare premium increases to your Social Security cost of living adjustment. When IRMAA applies, that limit is gone. At that point, 100% of your Social Security benefit becomes vulnerable to pay for healthcare costs. In some cases, the impact is severe. Your entire Social Security check can be absorbed by Medicare premiums. And if your benefit is not large enough, Medicare may bill you directly. That can mean writing quarterly checks to the federal government. Imagine paying tax on a Social Security benefit you never actually receive. This is why IRMAA is a retirement cash flow problem, not just a tax rule. And it ultimately comes down to 3 things. What are the Medicare costs today? What will those costs be in the future? And how much is coming directly out of your Social Security benefit? The good news is that not all assets count as income for IRMAA purposes. Properly structured Roth accounts can provide tax-free withdrawals. Health savings accounts can pay medical expenses without increasing income. Certain annuity strategies, life insurance, 401h plans, and home equity can also provide flexibility without triggering higher IRMAA charges. IRMAA is not something you ignore and hope for the best. It is something you plan for. By educating clients and managing how income shows up over time, we can help protect Social Security, reduce surprise Medicare costs, and preserve retirement assets.